Welcome back to the channel. I'm Ozbourne Foreman, and today we're going to be talking about the high street banks in the UK. There was an article posted by This Is Money, and it's talking about bank robbery in reverse. High street banks make an extra $7 billion from paying savers low interest rates, but charging more on mortgages and loans. Now, I'm going to talk about this article, talk about why it's more specifically misleading, and if you like this video, please drop one of these, as it is much appreciated. So it says here that high street banks made $39.9 billion from the widening gap between low savings rates and the high interest charged to mortgage and loan borrowers. No new figures show. Now, it's important to note here what this means. So this is your net interest margin, which is the difference between the savings interest rate, which is paid to obviously those that save money in the accounts, and that charged to borrowers with mortgages and loans. So the difference between that, effectively a spread here, is your net interest margin, and this is one of an income streams of the bank. And we go on to say that they've obviously made an extra $7 billion last year from net interest margins. And we talk about here, they go to about all the new findings. They've mentioned how the Bank of England has increased its base rate to from 0.25% to 3.5% in December last year, and it's now 4%, which has contributed to their greater earnings due to this net interest margin. Now, they factor in the base rate to financial products that consumers take out. Base rate hikes mean savers earn more, but borrowers pay more. But savvy consumers will have not failed to notice that they're currently paying 4 to 6% on most mortgage rates, while savers with big bank easy access deals earn pitiful rates of 1% or below. And this is backed up here, and this is current accounts, right? You can see on my screen I've got a high interest current accounts here. It's a little bit cropped off, but it will do. You got things like NatWest paying 1.51%. You've got the likes of Starling, which is the account I actually use, paying 0.05% on their account here. You've got Nationwide, which has a fix for the first year. This is why it says 5% here. There are some good banks about. I've got my emergency fund, for instance, with HSBC, and they've got like a restricted saver account that's alongside it that gets interest rate of about 3%. But you can tell here that considering the base rate's 4%, right, the banks aren't actually pushing this onto consumers unless it's in like a more regular saver. And I think that's wiser, really. I think it's a current account at the end of the day. I would love to have great interest rates in it, but realistically, you're going to have to look for more fixed saving products if you want to have those higher rates. Now, it goes on to say, and it talks about these major banks. They said here that the UK's biggest banking giant, Lloyds Banking Group, which includes Lloyds Bank, Halifax, and it says the Royal Bank of Scotland here. It actually just means the Bank of Scotland. The Royal Bank of Scotland is owned by NatWest Group, so don't get too confused there. And they had a net interest margin of 2.94% in 2022. Now, they made $13.1 billion from this in 22, which is up 18% from 21. So Lloyds Banking Group has done very well. And it goes on about other banks all showing similar trends here. And at this point, it's quite misleading. You're like, well, hang on, these banks are doing amazing. So what I found interesting about this is actually the comment section at the bottom. Now, there are a few comments here, and you've got the typical people that are going and understanding, but you've got people who are going, what big business profiting off the backs of hard-working people and probably avoiding tax? Surely not. And it goes further. I think there was one or two more comments here, like outright stealing of savers' money, and banks would be nowhere without money. It's almost as if the people making these comments don't quite understand the role of banks in the economy. But realistically here, what's actually going on is it's a perfectly normal practice for banks. And when we actually break down Lloyds Bank full year results, which I've got here on the screen, let me just drag this over for you guys. So Lloyds Bank, you can see at the top here, it's an income statement, underlying basis, and key balance sheet metrics. Their underlying net interest income, which is what we were on about earlier, right, has increased 18%. You can see this, it's now 13.2 billion. However, we go all the way down here and we look at the statutory profit after tax. It's actually less than what it was this time last year. So these people obviously reading the article, and it's not their fault because they'd have to do more due diligence. And the article here was suggesting, oh, actually, Lloyds has made more money. They've made even more money after tax. Therefore, they're profiteering off of savers. When in reality, actually, no, they're not. They're making less. The earnings per share has declined by 0.2 pence. Although, to be fair, they are paying out a greater dividend and they're pushing quite a lot of share buybacks. But it is interesting to think about. And it goes, would you invest in the banks in the UK? Is it a worthwhile deal? Now, I don't think so. I I like banks. I think they're in a good business position. I think the business models are great. But I don't like the way or how they really make money because they're very reliant on the central bank, in this case, the Bank of England. And realistically, when we look at some of their KPIs and we scroll down here, we've got loans and advances to customers. That's increased to £455 billion. Now, that is a huge number. We've got customer deposits that has increased or decreased, to 475 billion from 476 billion, right? And you might go, well, okay, look at the scale here, right? They've gained 8 billion in loans and advances to customers. That's good stuff, right? Well, realistically, I mean, I get it. With scale, this makes sense. But this is also the problem with banks. If you want something that's really got growth potential, perhaps banks aren't the answer for you. And it goes to the question, if you were to buy a bank, why restrict yourself to just the UK banks? We've also got, obviously, in the last few months here, the banking industry sector chart, which is based off an index of these constituents. You've got HSBC, Lloyds, and a few other uncommon ones. And you can see here that actually overall it's increased from about 3,200 to 3,900. So it's definitely been a bit of a value or a change here. Let me just drag that back so you can see it better. There we are. You definitely see a change going on here. But yes, as I say, what value is there in US banks instead? And we talk about the S&P 500, which is my favorite index by far. The largest 500 companies in the United States by market capitalization or size. Now, this index has returned a historic annualized average return of around 11.88% since 1957 to around the end of 2021. Now, over a 30-year period, a more realistic figure is probably about 8% per year on average, but this is good returns, and it argues about the idea of saving versus investing. You've got these people with their savings accounts going, I want more interest. Banks have got a base rate of 4%. I want at least 4%, when in reality, you're not going to make that much money through it. Savings accounts are purely that. They're there for the convenience of customers, right? You have got access to your money. The banks can lend out that money. That's their advantage. But for you, you're able to go, okay, look, I'm in a different part of the country. I haven't got any cash on me and I need to pay for something without using my card or even using my card, right? And I need to go to a cash point. Okay, I've got a cash point. Brilliant. I've now withdrawn £200 in Scotland, let's say, and I wouldn't have had access to that money otherwise because I didn't bring any currency with me. They are useful to consumers. We shouldn't expect banks to be paying a higher rate. And realistically, this is how it rolls. So you've got to go, okay, am I looking for longer or am I looking for high returns over a longer period of time? Then investing is truly key, which cranks me on to obviously the United States banks here. So we've got Lloyds performance so far, not a United States bank. Year to date, they're doing quite well. They're up 10.5%. The last year, they're up about 5%. But you go back further than that, you've got the same old trend, right? And because it's just downturned since about 1999 and obviously a Great Recession in 2007, you might go, well, it's only going to go down now. But you've kind of got to zoom in a bit, right? Each of these gains here in 2012 to 2013, right, or to 2014 is 100% gain there. So it's trying to zone out of here and go, what quality does this bank have? Now, one of the big short investors, which is Steve Eisman, right, he was the character in the film Mark Bourne, which was played by Steve Carroll. Now, he actually shorted, and this is back in 2018 here, so don't mislead you or anything like that. And he shorted actually a few of the largest UK banks. Now, I think from memory, he did actually cut his short here. I think it was Barclays that was one of them. I think it's actually on my other article here, which is, what was it? It was Royal Bank of Scotland, Lloyds and Barclays. Now, he'd done that because he was betting against the UK economy following Brexit. Now, I find this quite interesting. Perhaps most banks are in a good position, right? Well, aside from a few. Following the great financial crisis, there's been a lot more restrictions in place, which is a little bit out of my depth here, so I'm hoping someone can fill me in a little bit more in the comment section. Now, I'm going to assume here that maybe the UK banks have similar restrictions to that of the US, but the issue is their location. When you bet on Lloyds, when you buy shares of Lloyds, you're betting on the UK economy, you're betting on their mortgage book, and perhaps that's the advantage of the UK is the mortgage book because we've got a good property market compared to that of the US. So it's really worth weighing up here. Is it truly worthwhile? Now, if the big short investor, want to bet against the banks in 2008, bet against the banks again, the UK ones in specifically following the Brexit and the uncertainty following our economy, maybe that's a cause for concern. Maybe there's a reason here that we shouldn't do it. So what advantage would buying a UK bank share like Lloyds, like HSBC, like Barclays give us over buying something like JP Morgan Chase or something else? And I think that's a really interesting point here, and I'm hoping you guys might have some opinions of your own. Regarding my own portfolio, it's sitting at a balance of about £22,067. We've gone down a little bit in the last week. I think we're down by about £1,500. Boohoo has retraced a lot of their gains following the last week, and I think it's just a general share price volatility. We click into Boohoo here, which is probably going to be really slow. Yeah, it's down about 11% in the last week, so it was doing really well, and now it's cracked on down. Interestingly here, you can see my average price per share is £1.20. So obviously I'm sitting on a large uncrystallized loss here with Boohoo, which, you know, was my mistake earlier in the day. But we can see here that I've been buying a few more shares of Alphabet or Google, just slowly chipping away at this position. I suppose here a very good point to make is shares have fallen slightly right there over the last week. Should I be building a position just by, pumping a little bit of money in there every now and again? Or should I be going, okay, what is the fundamental reason for this position to drop? Or in moderation, should I go, okay, for now, I'm going to dollar cost average into this position, build up a certain size. Once I've reached that certain size, then I'll evaluate share price movements. If the shares have dropped from the price I've bought, then I need to seriously evaluate after a 15% decline. Is there a core reason for this? Does it mean the stock's undervalued, or is there now a risk that wasn't priced in originally by the markets? Is that risk worthwhile staying invested for? Is that a time to sell out? And I think really I'm trying to adapt from my mistakes I made, particularly with Boohoo, Argo Blockchain, and one or two others like Best of the Best, and go here, right, stocks declined by a certain amount. What's the fundamental reason for this? Is this a trend that could continue to happen? Or do I believe that over the longer term, will this improve? Will this be a factor? So you can see my position with Boohoo here. That's down 60%, right? A lot of people have told me, oh, you should sell. Oh, you should just buy other stocks with it. I believe in the long-term prospects of the company. I think the management are a bit dodgy. And if I had to go back in time, obviously, in hindsight, I wouldn't have bought shares of Boohoo, especially the way I did. That said, I do think the business itself is in a good position. So that's why I'm staying involved. But until they really start to make a turnaround, and they don't give us obviously any volumes information, they're a volumes-based business. But when we start to see that improve in their net profits, for instance, or their free cash flow, if that looks like a sustainable long-term trend, perhaps then I'd look to buy back in and lower my average. But for now, I'd be effectively gambling by buying at a cheaper price and lowering my average because I don't know how well it's going to perform in the next 5 years. I do believe they're in a good financial position to stay alive, and I do think they're a resilient brand that is certainly going to be around. I hope you enjoyed this one. I tried to go to a bit more depth than usual, and if you like that, don't forget to hit that subscribe button. I've got 2 videos coming out a week, and I'm aiming for a longer term video that's more of a helpful video for you guys, and then the more media related ones that I've got on the Sundays. Have a fantastic day.